For years, we've been told the same story about China's currency, that the yuan must stay weak, that China's fragile domestic economy depends on exports, and that any serious appreciation would be self-inflicted damage. But what if that story is quietly breaking down? Because beneath the surface, something has shifted. Not in speeches, not in slogans, but in data, in markets, in pressure building where it can no longer be ignored. China's trade surplus is exploding. Global tolerance is thinning. And the yuan, long assumed to be trapped under depreciation pressure, is now facing something far more dangerous for policymakers. Expectation. Expectation that it should rise. Expectation that it eventually must rise. And when expectations change, systems follow. If you want to understand how a currency becomes a political fault line and why this moment matters far beyond China, stay with me. Because to see where this pressure comes from, we need to step back and look at the structure that created it in the first place. At the center of this story is a contradiction that China can no longer keep neatly contained. On one hand, Beijing remains committed to exchange rate stability, a slowly moving yuan, predictable, managed, never a one-way bet. On the other hand, China's economic engine has become increasingly unbalanced. Growth is being carried by exports. Domestic demand remains weak. And net exports are now delivering a striking share of reported GDP growth, perhaps more than the official numbers admit. This is not just an economic issue. It is a structural one, because when a country runs persistent and rising trade surpluses, its currency does not exist in isolation. It becomes a signal to markets, to trading partners, to political systems already under strain. For years, private capital outflows, rate differentials, and a closed financial account helped offset this imbalance. That release valve is now narrowing, and as it narrows, pressure doesn't disappear. It concentrates. To understand why this imbalance became so large and why it now matters, we need to trace how China arrived here. To understand this moment, we have to rewind not years, but cycles. China's current currency dilemma was built slowly through a sequence of choices that once made sense. After the pandemic, domestic demand failed to recover with force. Consumption lagged, investment softened, growth needed an anchor. Exports became that anchor. An undervalued real exchange rate amplified competitiveness. A largely closed financial account trapped national savings at home, and global demand still absorbing cheap, abundant Chinese goods did the rest. For a time, this system appeared stable. Private capital outflows offset the trade surplus. Rate differentials favored the dollar, and the yuan weakened just enough to discourage speculative inflows. But cycles change. As export volumes surged and imports stagnated, the surplus grew beyond what these offsets could absorb. Meanwhile, global institutions began reassessing assumptions they had held only a year earlier. What was once dismissed as temporary started to look structural. The result is a familiar pattern in economic history. A model optimized for stability quietly generates its own instability. And when that happens, the first cracks don't appear in policy statements. They appear in stress points. That brings us to the first rupture. The first rupture did not arrive with a crisis headline. It arrived with a reassessment. International institutions that once downplayed China's currency misalignment began to change their language. Quietly at first, then more openly. The IMF, which only a year earlier reflected the old consensus, acknowledged what markets had already begun to price in. The yuan was significantly undervalued, and that undervaluation had powered China's export outperformance. At the same time, estimates of China's true trade surplus ballooned far beyond the officially reported figures. This was not an abstract debate. It was a warning flare, because trade imbalances of this scale are not absorbed indefinitely. They accumulate political weight, they invite retaliation. They test alliances already frayed by tariffs, elections, and slowing growth elsewhere. And suddenly, China's exchange rate was no longer a technical detail. It was back on the agenda at the IMF, in markets, and quietly inside finance ministries abroad. If you're Beijing, this is the most dangerous kind of shift. Not a shock, a consensus forming against you. And once a consensus hardens, it doesn't reverse easily. But the real tension wasn't external. It was building inside the system itself. What makes this moment so difficult for China is that the pressure is not coming from one place. It is emerging from the system's own design. China's financial account remains largely closed. Capital cannot flow freely in or out. On paper, that should insulate the currency. In practice, it traps pressure inside. When exports surge and imports lag, foreign currency accumulates. When private outflows no longer offset that surplus, the imbalance has to go somewhere. And increasingly, it flows through state banks. These banks have resumed accumulating foreign assets quietly, steadily, at scale. Not loudly enough to trigger formal accusations, but large enough to matter. Think of it as backdoor intervention, not a dramatic defense of a peg, but a continuous effort to lean against appreciation without correcting the underlying misalignment. The problem is arithmetic. The trade surplus is now larger than the pace of intervention, which means the system is no longer neutralizing pressure. It is merely delaying it. And delay changes behavior. If firms begin to believe that appreciation is slow but inevitable, incentives flip. Exporters hold less foreign currency abroad. Traders position for the long term. Stability, paradoxically, starts generating speculation. This is how controlled systems become fragile, not suddenly, but predictably. And once fragility sets in, the next stress point comes fast. The second escalation is sharper, faster, and harder to manage. For most of the past few years, China relied on an external cushion. Rate differentials favored the dollar. The yuan had already depreciated once. Tariff threats, downturn fears, and uncertainty pushed private capital out. That cushion is thinning. Private outflows are no longer keeping pace with the expanding surplus. As the yuan began to edge upward against the dollar, state banks stepped in, again accumulating foreign assets at an annual pace measured in the hundreds of billions. In absolute terms, it is enormous. In systemic terms, it is no longer enough, because the surplus underneath is larger still. This creates a dangerous asymmetry. Authorities are signaling that the yuan is not a one-way bet. But markets are reading the same data and reaching a different conclusion. Appreciation may be slow, but the odds are tilting. And when the probability distribution shifts even slightly, behavior changes rapidly. Exporters hedge differently. Firms bring offshore dollars home. Traders stop betting against the currency and start leaning into it. At that point, intervention must increase just to maintain the illusion of stability. Control becomes more active, more visible, and more politically sensitive. This is no longer a technical challenge. It is a credibility test. And credibility, once questioned, is expensive to defend. Which brings us to the point where this abstract pressure becomes personal. If you are watching this from the outside, this may all sound distant. Currencies, surpluses, state banks. But if you live inside the system, this pressure is not abstract at all, because when a currency is managed under strain, the costs do not disappear. They are redistributed. If appreciation accelerates, exporters feel it first. Margins tighten, hiring slows, risk tolerance shrinks. If appreciation is resisted, trade tensions rise. Tariffs follow, markets close, growth becomes more fragile, and in both cases, uncertainty spreads downward. For households, that uncertainty shows up quietly, in postponed purchases, in cautious saving, in the sense that the system is being managed but not resolved. You, as a citizen, are not choosing between appreciation or stability, you are living with the consequences of delay. This is why exchange rates matter more than headlines suggest. They shape incentives. They shape confidence. They shape the future before it arrives. If this perspective is helping you see the system more clearly, take a moment to stay engaged. Understanding is the first form of agency, because this pressure does not stop at China's borders. What happens inside China does not stay inside China, especially when it involves trade and currency. China's surplus is not just large, it is increasingly out of sync with global demand. Exports continue to outperform global trade, while imports lag far behind. That gap is felt elsewhere as lost market share, factory closures, and political backlash. This is why tolerance is eroding. Trading partners can accept imbalances when they appear temporary. They react when those imbalances look permanent and policy-driven. As the yuan remains undervalued in real terms, pressure builds abroad. Finance ministries take notice. Central banks run scenarios. Trade officials prepare responses they would rather avoid. This is not about hostility toward China. It is about system limits. The global trading system is already strained by tariffs, elections, and slowing growth. Adding a near $1 trillion surplus into that environment is destabilizing, which is why currency management is no longer a domestic choice. It is a geopolitical variable. And once exchange rates become geopolitical, room for quiet adjustment shrinks. That leaves China facing a future that no longer offers easy paths, only trade-offs. Looking ahead, China now faces three broad paths. None are clean. All are costly in different ways. The first is gradual adjustment. The yuan is allowed to appreciate slowly, just enough to signal responsiveness, not enough to shock exporters. Intervention continue. The surplus narrows only marginally. Tensions ease but do not disappear. This is the path of management, not resolution. The second is stagnation through control. Appreciation is capped. Intervention rise. Imbalances grow. And pressure shifts outward into tariffs, trade cases, and political retaliation. The currency stays stable, but the system becomes brittle. The third is forced change. A shift in capital flows, expectations, or politics overwhelms control. Appreciation accelerates. Latent demand for yuan rushes home. Stability is regained, but only after disruption. What matters is not which path looks best on paper. It's which one the system can sustain without breaking trust. Because currencies are not just prices, they are promises. And once a promise is doubted, managing the future becomes far harder than accepting it. That brings us to the final question this moment forces on China and on everyone watching. China's currency story is no longer about defending an exchange rate. It is about choosing what kind of system comes next. For years, warnings against one-way bets were enough. Signals worked. Markets listened. Today, that language is losing power because the pressure on the yuan is not speculative. It is structural, built from trade surpluses, trapped savings, and a global system reaching its tolerance limits. China can slow appreciation. It can manage expectations. It can intervene more aggressively, but it cannot escape the arithmetic forever. Every system eventually confronts the gap between stability and sustainability. This is that moment. The choices ahead will shape not just China's currency, but its relationship with the world and the confidence of its own people. If you want to follow how this story evolves, stay with me. This is not the end of the currency debate. It is the beginning of a more consequential phase. Because when pressure builds quietly for long enough, release is never trivial.